Did you know the IRS can tax you for crypto you didn't even ask for? That's right. Hard forks and airdrops can create unexpected income. In this video, I'll break down what forks and airdrops are, how the IRS wants you to report them, and show you examples so it all makes sense. A hard fork is when a blockchain splits into two different chains because the rules change. Think of it like a software update, except not everyone upgrades. One group keeps the old version, while another creates a new chain. For example, in 2017, Bitcoin Cash split off from Bitcoin. If you held Bitcoin before the fork, you may have also received Bitcoin Cash on the new chain. That's a hard fork. An airdrop is when new tokens are distributed to wallet addresses, often for free. Companies use airdrops to reward early users, promote a project, or launch new tokens. Airdrops can happen on their own, or after a hard fork. For instance, after some forks, new coins are airdropped into your wallet if you held the original coin. Now, how does the IRS tax these events? Let's go straight to their guidance, Revenue Ruling 2019-24. If a blockchain hard fork happens but you don't get any new coins, no income. If a fork leads to an airdrop and you do receive new coins, the IRS says that's ordinary income. The income amount is the fair market value of the new tokens at the moment you have dominion and control. That means you can transfer, sell, or use the new crypto. So, if your exchange doesn't support the new coin and you can't access it, no income yet. But once it's credited to your account and you can trade it, that's when the IRS expects you to report income. Let's make this simple with examples. Example 1. You own 10 ETH. A fork creates a new chain called ETHX. You receive 10 ETHX via airdrop. At the time you gain access, ETHX is worth $500. You must report $500 of ordinary income. Your cost basis for ETHX is $500. Example 2. You own 1 BTC. A fork occurs, but your exchange does not support the new coin. You don't receive anything. No taxable income because you never had control of the new token. Example 3. You get an unsolicited promotional airdrop worth $20. Technically, it's still taxable income, but in practice, most taxpayers focus on meaningful amounts. Here's how reporting works. When you first receive the airdrop, report the fair market value as ordinary income. Usually this goes on Form 1040, Schedule 1, under Other Income. Later, when you sell or trade those tokens, report the transaction on Form 8949 and Schedule D for capital gains or losses. So yes, it's a two-step tax event: income when you receive, capital gain or loss when you dispose. Here are some pro tips. Keep detailed records: date received, time, USD value, and whether you had control. Distinguish hard versus soft forks. Soft forks usually don't produce new coins and aren't taxable. Be aware of spam airdrops, technically taxable but often negligible. Track everything with crypto tax software like Coinly, CoinLedger, or Token Tax. They handle cost basis and reporting automatically. So here's the bottom line. Hard fork without new tokens? No tax. Hard fork with an airdrop you can control? Taxable income. Later sale? Capital gains or losses. Keep records, stay updated, and don't let unexpected IRS rules catch you off guard. If this video helped, hit like, drop your questions in the comments, and subscribe for more crypto tax breakdowns.